Now we got the recorder going. Okay, so today what we're going to do is we're going to talk about income tax. And income tax, there's a lot more to it than sales tax. That's for sure. So first, let's talk about what income tax is, where they come from, and then we'll start picking at the pieces and start building up to actually computing income tax. Okay. So income tax is a tax that's levied on earned income or profit. Okay, so income taxes can be collected by federal governments, states, and sometimes even like cities and stuff or counties. And for like our federal government, when our country started, there was no federal income tax. Okay, but now it is by far the biggest source of income for the federal government. Okay. The same thing is true with most states. Most states get the majority of their funding through income tax. However, some don't collect any income tax at all. Okay. And the income tax, at least at the federal level, everyone's supposed to file unless you don't make very much money, right? So anyone who earns an income over a certain amount, and I think that's around $10,000 for an individual, you have to file a tax return. Okay. So if your 9-year-old sets up a lemonade stand and makes $24 for the year, they don't have to file income taxes. However, if your 9-year-old sets up a lemonade stand and makes 20 grand for the year, they do have to file income taxes. There is not an age requirement on income taxes. You're not safe because you're young. You're only safe if you don't make very much money. Okay. So states, 41 states and the District of Columbia all collect income taxes. Okay. Some states do not. Some states collect tax only on investment income. Okay. And it varies by a lot, from state to state. In Illinois, we have what's called a flat tax. So we'll talk about this. Maybe we'll go through an example of this tomorrow. Filing Illinois taxes are a lot simpler than federal income because it's just a percentage of your income, and that's basically it. Okay. Some municipalities can collect income taxes, although most of them, I think, do not. Okay. Typically, income tax is going to be everyone pays federal and most people pay state, and that's going to be generally it. Okay. But there are some municipalities that do collect income tax. Okay, what we're going to do today is we're going to look at federal income tax. And what I want to do is give you maybe a little bit of an overview of what this process looks like for how your taxes are calculated. Okay. So the first thing that we do is we start with what's called your gross income, and that's just all of the money that you took in. Okay, and anytime you made money, whether it was a paycheck, okay, whether you did an odd job and got paid cash, somebody donated money to you, all of that is part of your gross income. Okay. What I find interesting is if you rob somebody, okay, if you rob a bank, you're still supposed to file income taxes on the money that you stole, and if you don't, that is a separate crime. Okay, so the IRS doesn't care where you got the money. You gotta pay taxes on it. Okay, after we calculate your gross income, we look at something called adjusted gross income. So adjusted gross income is your gross income, and then this is a subtraction here. We'll go through this in more detail later, though. We take your gross income and we take away adjustments, and that gives you your adjusted gross income. Okay, and we'll go through this in a second. And then from there, we go to calculating your taxable income. So that's taking your adjusted gross income and taking out deductions. Okay, and then from there, we calculate the tax on your taxable income. Okay, and we'll look at that. That's a complicated process. I mean, not really, but it looks really complicated at first. And then from there, we take the tax that we computed, we subtract the credits, and then we subtract any amount of tax you've already paid, And if what you get is negative, you get a refund. And if it's positive, then you pay taxes. Okay. So with this withholdings, what happens is every paycheck, you'll notice that some amount of money is taken out for taxes. Okay. Those are withholdings, right? So you kind of pay your tax as you go. And then at the end of the year, we sort of make an adjust, an accounting for, did we pay the right amount? Okay. And we fix it. Okay, so let's go through this in detail. We talked about a gross income. Adjusted gross income, adjustments are things that are typically taken out of your paycheck before it comes to you, okay? So usually things that are adjustments are things like contributions to your retirement plan, okay? Or contributions to like a health savings account, okay? So those things are not taxed, but they're also usually taken out of your paycheck before it comes to you. They don't have to be, okay? But that's typically what adjustments look like, okay? So let's look at an example of gross income and adjusted gross income. So let's suppose Sasha received $45,000 in wages, okay? So her gross well, start with gross income. So we have $45,000 in wages and $1,300 in interest from a savings plan. Okay, so if you have like savings account or certificate of deposit, or you have stuff that earns money over time, the interest on that is money that's going in your pocket, so that's considered income. Now, it can get complicated. Like if you own stocks go up and down in value, but the money's not in your pocket until you sell them. So that works a little bit differently. Okay. But the amount that you gained from selling stocks, that's also taxable. Okay. Sometimes that's different though. Sometimes you call that capital gains, depending on what we're talking about. Okay, let's keep it simple though. All right. So we have $45,000 in wages and $1,300 in interest from savings. Okay. So then our adjusted gross income, we add these up and we get $46,300. Okay. So that's our gross income. Okay. Then we have $1,400 in student loan interest and $4,000 in an individual retirement account, an IRA. Okay. So our adjusted gross income we start with our gross income, $46,300, and we take away the adjustments, okay? And so the student loan interest and the IRA contribution are adjustments, okay? Now, I want to be clear about this as we go forward. The point of going through this unit is for you to learn about taxes, and it's helpful to learn about stuff that you might actually encounter. However, this is a math class, not like a business class. It's not a taxes class. So there's only so much level of detail that we're going to be able to go into. And there's to a lesser degree, an amount of detail that you're going to be tested on. So you're not going to be asked on a test, is student loan interest an adjustment or an deduction, or classify that. I'm not going to be super picky about, do is this an adjustment versus a deduction, things like that. We'll try to go over that a little bit, but we're not going to be really picky about that on test. What we want to do is say, okay, do you kind of understand what adjustments are and how they work and how they differ from, say, a deduction that we'll talk about later. Okay, so let's subtract out the adjustments. Okay, so we have our $46,300. We take away $1,400, and we also take away $4,000. So we get an adjusted gross income of $40,900. Okay. All right. So in general, the way that this process works, we start with your gross income, that's how much money you make, and we take away from that. We take away adjustments, and we'll take away deductions. So when you pay taxes, you don't actually pay taxes on all of the money that you earned. You pay taxes on a smaller amount, okay? All right, so let's get to taxable income. Taxable income is determined by subtracting your deductions from your adjusted gross income, okay? And when we talk about deductions, there is something called a standard deduction. Okay. And then there's also what's called itemized deductions. Okay. So a standard deduction is a fixed set amount, okay, depending on your filing status. So if you're single, it's one amount. If you're married filing jointly, it's, I think, double that. Okay. And the idea is, I think, that to help simplify things, if you don't have a huge amount in deductions, you can just use this standard deduction instead, and that way you don't have to track every receipt and things like that. Okay. But if you have a lot of deductions, then you want to use those instead, then you track those. Okay. So itemized deductions are your actual deductions. So that's things like the amount of money that you pay in income taxes and property taxes and medical expenses and mortgage interest and charitable donations. Those are all deductions, okay? Sales tax, you don't have to pay tax on tax. So you can actually take the amount of sales tax you paid over the year and deduct that, okay? Now, that's kind of a painful tracking process, right? I don't keep every receipt from everything I've bought over the year, which means that I can't use my sales tax as a deduction, okay? But if I wanted to, then I would have to, keep track of that. Okay, I'm going to give you a little bit of history. Prior to 2018, when they wrote a new tax law, there was also something called personal exemptions. And an exemption was just a fixed dollar amount per person, right? And in 2018, I think it was $4,050. Okay, so everybody that was a dependent, including the person themselves who are filing taxes, count as a person, and you subtract that amount. Okay, so what it was just sort of like a straight off the top, we're going to take away from your income based on how many people are, in this group that we're filing taxes for. Okay. Starting in 2018, they got rid of that, and instead they increased the size of the standard deduction, right? They doubled it. All right, so we'll look at that in a minute. Filing status, all right? In this class, we're only going to talk about maybe a couple of these, but I want to list some of these out. There's a lot of different statuses for how you file, right? So, obviously the single is like the default simple one, right? If you're just one person by yourself, okay, you're not married or you're legally separated or you're divorced, then you file a single, okay? If you're married, you can be married and file your tax return together, or the two of you can file separately, okay? Typically, filing jointly is going to be better, especially if you make different levels of income, okay? Because the married filing jointly, it's sort of like everything is not quite, but like almost doubled from single, okay? So we'll look at why this makes a difference later, but if you and your spouse don't make the same amount of money, then married filing jointly will save the two of you together money on your taxes typically. All right. You can also file as a head of household. So this is going to be a situation where you have dependents that live with you, such as children, but it could also be like if you're taking care of elderly parents or something like that. Okay. But you're not married. Okay. Now, the thing is, when we talk about dependents, whether we're married and we're talking about kids or head of household, a dependent can only be on one single tax return, okay? So part of being a dependent is the person filing has to have paid more than half of the cost of upkeep for you, okay? Which means that you can't have two people that have both paid more than half, right? So you can't have two tax returns that have a person on them, right? So, when you talk about kids, if you have maybe two people that have kids but they're not married, they can't both claim the children. You can maybe split the children up. One person gets this child, one person gets that child on their taxes, okay? But you can't both take them, okay? There's also separate filing status for being a widow or widower. Okay. Earlier we talked about this idea of a standard deduction. Let me go back and look at that. The standard deduction is different based on your filing status, and I didn't label all of the filing statuses here, but here's some of them: single, married filing jointly, married filing separately, and head of household. Okay. Notice that the married filing jointly is more than double of the married filing separately. Okay. So you typically have to have a very good reason to be married and file separately. Okay. Head of household, you kind of get a bump from being single, but it's not quite the same as being two income earners. I think the idea behind it is married, you have two adults with a bunch of dependents. Okay. Head of household, you have one adult with a bunch of dependents. Right. Single, you don't have any dependents. All right. Now, this is the value of the standard deduction. What's important to note is that the standard deduction or your itemized deductions, right, you take that money off of your taxes. So whichever one is bigger is the one you want to take, but you can't take both. So I can't say like, oh, I donated $200 to charity. Can I take my $12,400 and also my $200? No, it's one or the other, and it only makes sense to take the bigger of the two. So if you take your standard deduction, then your itemized deductions don't really mean anything. Okay. So let's look at an example. Suppose Robert has $3,200 in work expenses, a $500 car that he donated to charity, and $1,200 worth of items for his classroom. Okay. So these are, again, examples of things that are deductions. Money that you have to spend as part of your job, you can deduct off your taxes. Okay. So like if you have to buy your own uniform or something like that, okay, you can take that as a deduction. Donations to charity are a deduction. If you're a teacher and you spend money on stuff for your classroom, that's a deduction. Okay, so if I add these up, the total of our itemized deductions we have $3,200 plus $5,000 plus $1,200. And when we add these up, we get $9,400. Okay. Robert's filing as an individual, and for an individual, the standard deduction is $12,400. That's worth more. So in this case, Robert should use the standard deduction, and then he would not use his itemized deductions. Okay, so his deduction is $12,400. Okay, let's look at another example. Rose is filing as a head of household. She has $4,000 in sales tax to deduct, $9,000 in qualifying health insurance premiums, and $6,200 she paid for babysitters, and then $1,000 to her church. So again, these are all deductions. So you can deduct the sales tax that you paid over the year. Health insurance is a little bit tricky. Okay, a health savings plan that's taken out of your paycheck ahead of time, you can deduct all of it. For medical expenses, though, including the premiums for your health insurance, you can only deduct them if they're at least 7.5% of your adjusted gross income. Okay, so again, with things like deductions, that's where things get tricky, and that's why a lot of people get scared about filing their own taxes, because there are a lot of questions that come up that sometimes you don't know answers to. Okay, all right. So if you have a lot of health expenses, you might want to look into that and see, okay, is this qualify as a deduction or not? Okay, and it's not, that it's not that hard to figure out. You look at your adjusted gross income, 7.5% of that, is that more? Okay, so let's look at this. So here are itemized deductions. We have our $4,000 in sales tax. We have our $9,000 in health expenses. We have $6,200 for babysitting that you can deduct. $1,000 donation to church. Okay, church is a charity, so you can deduct that. Okay, so we end up with a total of $20,200. Okay, Rose is filing as a head of household, so her standard deduction is $18,650. Since her itemized deductions are higher, she would use her itemized deductions and then not the standard deduction. Okay. Okay, so again, it's one or the other. Whichever one is bigger, you don't get to ever combine them. Okay, that's deductions. Let's move on to calculating income tax. This is the part that I think can be confusing, and this is why I think this is the part that it is most important for us to learn in this class. Okay, so by understanding how income taxes are computed, I think that you can better understand whether or not the changes to tax law are better for you or worse for you, or whether they impact you at all. Okay. I think they can also, by understanding this, we can also help dispel some common misconceptions about taxes. Okay. So we just want you to be informed. That's the goal here. So let's take a look at this. All right. Federal income tax is a progressive tax. That means that as you make more and more money, it's taxed at a higher percentage. Okay. So if I have what's called a flat tax, suppose tax was just 4%. Okay. If you make $10,000 and you're taxed at 4%, and you make $100,000 and you're taxed at 4%, obviously the person who makes more money is going to pay more in taxes. But both of you paid the same 4%. For federal income tax, that's progressive tax, you pay different rates as you make more money. Okay. So the percentage goes up. All right. The way that it goes up, though, is everyone, whether you're making $10,000 or whether you're making millions of dollars, your first chunk of money is taxed at 10%. Okay. And I only put two categories here, the single and married. Let's just talk about single for a moment. So for everyone who's single, your first $9,950 is taxed at 10%, no matter who you are. Okay. The money that you make past that is taxed at 12%, up to $40,525, right? And then after that, it's taxed at 22%, right? And so on. Okay. So let me show you, I think it's probably best to look at this as an example. Okay. So let's suppose that we have a single individual with a taxable income of $52,000. So we're skipping all the adjustments and deductions and stuff and just saying, okay, let's look at this taxable income of $52,000, compute the amount of income tax. Okay. So what I want to notice here is that $52,000 falls into this 22% bracket, right? That's in between my $40,000 and my $86,000. Okay. The way that I like to think of it is this $52,000 that we made during the year. What we're going to do is we're going to dump that money into some buckets. We have our 10% bucket. We have our 12% bucket. And then we have our 22% bucket. And we didn't make enough to go higher, so we don't need to label all the other buckets. Those are going to be empty. Okay. So what we do is we pour our money into this 10% bucket until it's full. This bucket holds up to $9,950. So $9,950 of our income goes into this 10% bucket. Now it's full, so we start dumping into the 12% bucket. Okay, this goes up to $40,525, but it doesn't start at zero, so I can't dump $40,000 into it, right? I'm dumping the money starting with $9,951. Okay, so if it can hold up to $40,525, but the first $9,950 is already accounted for in this 10% bucket, then I can subtract those. So I'm going to take $40,525 minus $9,950, and that gives me how much money I can hold in this 12% bucket. So $30,575 of my money is taxed at this 12% rate. Okay, so this is how much is taxed at each of these rates. Okay, now this final 22% bucket goes up to $86,375, but I didn't make that much money, so I don't need to use that number for anything. Okay, what we want to do is just put all of our remaining money into here. Okay, and since we've already accounted for $40,525 of our income, it's only the money past that, or the difference between what we made and that $45.25, that gets thrown into this bucket. So what we're going to do is we're going to take our income, $52,000, and subtract the $40,525. Okay, so we get $11,475 that gets taxed at that 22% rate. Okay, so one of the things to keep in mind here is even though this person is in the 22% tax bracket, most of their money is getting taxed at 12%. Okay, not 22. Most of it's at 12, some of it's at 10, and some of it's at 22. Okay. All right, so now let's compute the amount of tax. So the tax is going to be just a percentage of that amount of money. So in the 10% bucket, I'm taxing at 10%. So we take 10% of $9,950, and we get $995. Okay. In the 12%, we're taxing at 12%, so I take 12% of this amount of money, $30,575, and we get $3,669. Okay, and then finally, the 22% bucket, we take 22% of the amount of money that's in there, $11,475. Okay, and we get $2,524.50. And for our purposes, we're going to leave the pennies on there. When you're filing for taxes, things often get rounded. However, when you're filing for taxes, they do a lot of this computation for you. Okay, so then our tax owed, our computed tax, is $995 plus $36.69 plus $25.24.50. Okay. So we get $7,188.50. Okay. One of the things that I want you to notice, okay, I'll just bring up my calculator for this. If I look at how much money is in the 10% bracket, oops, too many zeros, plus how much money is in the 12% bracket, plus how much money is in the 22% bracket, I get exactly this person's taxable income, okay? The idea is that we took this $52,000 and we broke it up into 3 pieces. All right. So that I think, I don't know, if you understand that, then maybe it makes this whole process a little bit less confusing. Like I said, I think this part that we're doing right now is the most confusing part of the income taxes. All right, does anybody have any questions so far? Okay, let's do another example. I think that'll help. I want you to make a observation here between these two examples. In this example 30, we have a single individual with a taxable income of $52,000. The next example, we have a married couple with a taxable income of the same amount, $52,000. Okay, so it's the same amount of money that they pay taxes on, but they're filing married instead of single. Okay. All right, so let's figure out how much goes into each of these. So if I look back at my tax table up here, for a married couple, $52,000 doesn't make it to the 22% bucket. Okay, $19,400 goes into the 10%. Okay, and I don't use this one at all. Okay, so then the difference will go into this 12%. So we're going to take our 52,000 and subtract the 19,400 that was accounted for in the previous tax bracket. Okay, so here we get $32,600. Okay, so now we take a percentage of those. So 10% of $19,400 is $1,940, and 12% of 32,600 is $3,912. So our computed tax, when I add these two together, is $5,852. Okay. So notice that that's significantly less than when you file singly, right? And it's the same amount of money that's taxed, but the difference is that when you have a married couple, right, two people filing together, the thresholds for these tax brackets are higher. So more of the money was taxed at a lower percentage, right, at 10% and at 12%, and none of it was taxed at 22%. Okay. So we end up with less total tax. All right. We don't have the full story yet. Next, we have to talk about tax credits. Okay. A tax credit is like a refund to you from the government. Now, at the beginning, we talked about adjustments and deductions. And a way to think about that, adjustments and deductions lower the amount of money that you pay taxes on. Okay. So for example, if I get so many dollars in my paycheck and I have to use some of that for business expenses, or I choose to give some of that away to charity, then they say, oh, we're not going to tax you on the money that you spent on those things. Okay. So they're just lowering the amount that you pay taxes on. Okay. And if I'm paying taxes in this 12% tax bracket and I lower my income, then it's 12% of whatever I'm lowering it by that I'm going to save on my taxes. Okay. With a tax credit, the credits are exactly their face value. They're applied after you compute your tax owed, and they're just subtracted off. That means that if the government gives you a $500 tax credit, that's worth $500, right? All of that money is just like money in your pocket, okay? And it's typically given as reducing the amount of tax that you have to pay by that amount. But there's actually two types of tax credits. There's what's called a refundable tax credit and a non-refundable tax credit. Okay. A non-refundable tax credit lowers the amount of tax you owe, but it's not allowed to go below zero. So if I look at this previous example, if this couple had $6,000 in non-refundable tax credits, then that just means that they would owe $0 for taxes, but it wouldn't go negative. However, if they had refundable tax credits, then you can actually lower your tax burden to below zero, and that means that the government pays you money for the year instead of you paying the government for the year. Okay. And some tax credits are a mixture of the two. So we're going to talk about a couple tax credits that are common ones to run into. Okay. So first, the child tax credit. And this one is fairly straightforward, except that nothing is straightforward with taxes, right? The child tax credit's a credit of $2,000 per dependent child. Okay, so when we say per dependent child, having a child biologically is not the same as having a tax-dependent child, right? So a tax-dependent child, there's an age restriction, right? Once they, grow up, you can no longer claim them as a dependent child. There's also the restriction that we said before: a single person cannot be the dependent of two people's taxes. Okay, so for example, if you have two parents that file their taxes separately, they can't both claim the same child. Or another way to look at that is, if you're just starting college, you're working a job now, either you can claim yourself or your parents can claim you, but not both. Okay, so if you claim yourself on your taxes, then your parents can't claim you. However, you're not your own child, so you won't get a child tax credit for yourself. Okay. So this is a credit of $2,000. $1,400 of that is a refundable tax credit. Okay. So it can lower my taxes by $2,000, but if I have one child, I can only go negative by $1,400. We'll look at an example of that. Okay, here's another tax credit, the earned income credit. So the earned income credit, I think generally speaking, is a tax credit for low-income people and families when they're filing taxes. Okay. Now, what I have here in this chart isn't how much you get for the credit. What we have in this chart is based on how many children you have and your filing status. This is the maximum amount of money that you can make and still get an earned income credit. Okay, so if you have 0 children and you're filing as either single or head of household or widowed, then you can make up to $15,800 on your adjusted gross income. Okay, so it's the adjusted gross income that is the determining factor. If you're married, the threshold is a little bit higher, right? Married filing jointly, you can have a slightly higher threshold. Okay. If there are more children, then you can make more money and still get the credit. Now, something to keep in mind: if you have a married couple with 3 children that earns $56,844, they're not going to get the full value of the credit. Okay. The credit sort of scales back. The more money you make, the less credit you get. And once you hit this threshold, you don't get anything. Okay. All right. So, we'll look at an example, but I think the easiest way to figure out how much you qualify for is just to use the IRS, website, right? They have this little app. You answer some questions and you figure out how much your earned income credit is. Okay, so let's look at an example of that. So what we're going to do is we're going to combine everything that we've learned so far together. We're going to find tax owed by a family, right? So tax owed by the Lopez family. So they're a married couple filing jointly with 2 dependent children and a gross income of $42,500. Okay. We're going to say that they have $2,500 in adjustments. Okay. And we'll just say no itemized deductions. That doesn't mean that they don't have any. They just didn't keep track of them. They don't care. And again, remember, for deductions, if you're a married couple and your deduction threshold your standard deduction is $24,800. Okay. For a lot of married couples, if you're not making a huge amount of money, you're not going to come anywhere near that, right? If I look at this example, that's half their income, they didn't spend half their income on deductible expenses, right? So they're pretty safe not tracking all of their itemized deductions. They'll just take the standard deduction. Okay, so the first thing that we want to do is find the adjusted gross income. So our gross income, we'll just write down, it was given as $42,500. Okay, the adjusted gross income, we take our $42,500 and we subtract out the adjustments, $2,500. Okay, so we get $40,000 for adjustments. Now, I cheated a little bit and I told you what the earned income, this EITC, earned income tax credit, I cheated and told you what it would be. But what I want to do is I want to look at that really quickly and see if we can go through the process. So the website that I included is this one. This is just the IRS website. And you can just kind of quickly click through. Okay, so I want to see, all right, 2020, are we a citizen? Yes. Valid Social Security number? Yes. Are we filing foreign income? We'll say for this family, no. Will someone else claim you as a dependent? No. Please select the range that describes your age at the end of 2020. It wasn't given in the problem, but we said that they're married with 2 children. We'll just assume they're between 25 and 64. Okay. Do I know my filing status? Yes. We have married filing jointly. Yeah, our spouse has a valid Social Security number. And we said that they had 2 children. Estimate your adjusted gross income. So we said that their gross income was $42,500. Okay. We'll just add that all as their wages, salaries, and tips. Okay. And then what do we say their adjustment was from? Contributions to health savings and moving expenses. All right, so contributions to a health savings. It also said moving expenses. We don't know how much is each, so what we're going to do is we're just going to put that here. Okay, so HSA is health savings account. Okay, so our adjusted gross income is $40,000. Yes, that's correct. Oh, there we go. None of the above, none of the above. Okay. Qualifying children. Okay, select each child that lived with you more than half, first and second child. Select each child who can be claimed on someone else's tax return. No, nobody's being claimed on someone else's. Select each child who's married. We'll say that these are non-married children. Select each child who's permanently and totally disabled. We'll say none. Keeping things simple for now. First child's a child, under 18. Second child's a child, under 18. Yeah, so it takes a little bit to go through this, but it's pretty easy. Here we go. Based on the information you provided, you're eligible for an earned income tax credit of $2,802. What did I write? Oh, I have the wrong amount. Maybe I used the wrong year. Yeah, 2802. Okay, so that's the process of going through an earned income credit. So if, that I know there was a lot of clicking there, but that wasn't really too difficult. I didn't have to think very hard. And it's, worth going through to, essentially get paid or, save, in this case, $2,802, right? So I think that we spent maybe 3 minutes on that. Okay. I mean, if it takes you 3 minutes to make $2,802, then you're working at you're making pretty good money for your time there. All right. So that's how much we'll get for the credit. Let's back up a bit though. Our process, calculate gross income, we did that. Calculate adjusted gross income, we did that. Okay. And then I got hung up on the credits, but we're not going to use those until the end. Next step is to calculate the taxable income. Okay. In order to do that, we need to figure out what deduction we're going to use. Okay. So in this case, it's easy because they have no itemized deductions. So we're going to use the standard deduction, which, here we go, for a married couple filing jointly is $24,800. Okay. So our taxable income is going to be the adjusted gross income minus the deductions. Okay, so we take our $40,000 and we subtract out the $24,800. We get $15,200 in taxable income.
The 15,200?
Yeah, 15,200.
Oh, okay, thank you.
Yeah. Okay. So once we have the taxable income, that's when we go to those tax brackets, right? The marginal rates. So if I go back up, for a married couple, 15,200 actually lands us in all of it is just in that 10% bucket, right? We don't even fill up the first one. Okay. So if I'm looking at my tax brackets here, all of my $15,200 of taxable income goes in that first one, and then we're done. So then the tax is 10% of 15,200, which is 1,520. Okay, so that's the computed tax. Okay. All right. After that, after we figure out the computed tax, that's when we go and we look at the credits. Okay. So we said that we have this earned income tax credit of $2,802. And then because we have 2 children, we can also take the child tax credit. And we said that that's $2,000 per child. Okay, so when we go to compute our credits, well, when we compute the tax owed, we take our computed tax and we subtract the credits. Okay. Oops, I put an extra 0 on our tax that we paid. Okay, so in this case, the tax owed goes negative. All right, now, if your tax owed goes negative, you have to be a little bit careful, right? So here we got negative $5,282. Okay, since that's below 0, we have to be careful about the difference between refundable and non-refundable credits. If your tax owed is still positive, then it doesn't matter whether the credits were refundable or not. Okay. Okay. So remember that the earned income credit is refundable. For the child tax credit, we said it's $2,000, $1,400 of which is refundable. Okay, so so $1,200 is non-refundable. Okay, and the remaining $2,800 is refundable. Okay. So when you're computing credits, you first subtract off the non-refundable credit. Okay, and in this case, our non-refundable would not cause our tax to go negative. Okay, so we do indeed get this full amount back, right? These people are actually going to get paid $5,282 instead of paying taxes. Okay. All right. Any questions so far? All right. Let's do another example. So here we have a married couple filing jointly with 3 children with a total gross household income of $212,500. Okay. We'll say no adjustments, and we have some deductions. Okay. So let's figure out what's going on, right? Okay. So our gross income, we were given, and that's $212,500. Okay. The adjusted gross income is the gross income minus adjustments. And in this example, we said that they don't have any adjustments. So we'll just leave it as $212,500. Okay. Now we figure out deductions. So for our itemized deductions, we said that we have $12,400 in property taxes, $15,875 in mortgage interest. So when you buy a house, you get a big mortgage on it, right? We talked about that, and the unit, what was it, 7, 6? I don't remember. The interest that you pay on your mortgage is tax deductible. Okay, so in that sense, buying a house, I mean, there's some hidden savings in there. Okay, then we had charitable contributions. Okay, and we're going to add all of those up. So 12,400 plus 15,875 plus 15,000, and we get a total of 43,275. The standard deduction they're a married couple filing jointly. So if we go back up, we see, okay, $24,800. Okay, we always pick the larger of the two. In this example, the itemized deductions are larger, so we use that. Okay, so our taxable income is going to be the adjusted gross income minus our deduction. And our adjusted gross income was $212,500. And for our deductions, right, we use the itemized deductions, 43,275. Okay. So again, you cannot use both. It's either your itemized or the standard. Okay, so the taxable income is $169,225. Okay, so now we go to the tax brackets, right? So we have our 10% bracket, 12% bracket, 22% bracket, and we can go, we keep going until we find out where they land, right? And so they have 169,000 in taxable income. Okay, that'll land us into the 24% bracket. So not much, but a little bit of their income is going to go into that 24% bracket. Okay, so the 10% bracket holds up to $19,400. Okay, the 12% bracket goes up to $78,950. But I want to subtract how much has already been accounted for. We've already accounted for the first $19,400 in the 10% bracket. Okay. All right, so we have $59,550 in this 12% bracket. Okay, the 22% bracket goes up to $168,400. But we've already accounted for the first $78,950 between the first two. Okay, so we have 89,450 in this bracket. And the 24% bracket, that's where we land, so we don't look at its upper value, we just say, okay, well, how much of our income, okay, do we have? 169,225, and we subtract out the 168,400 that has already been accounted for. Okay, so we only have $825 that's taxed in this bracket. Okay, and again, if we want to just double check, if I add up these numbers that I got, okay, in each of my brackets, they should add up exactly to my taxable income, right? So 19,400 plus 59,550 plus 89,450 plus, and that last one was 825. Okay, you see that we get exactly our taxable income when we add them up. Okay, because what we're really doing is taking our taxable income and breaking them up into, in this case, 4 groups. Okay, so we want to make sure that we've subtracted the correct numbers, and that's a good way to double check to make sure you didn't make a mistake. Okay.
Quick question.
Yeah.
So for the 24%, where did you get the $169,225 from again? Just the taxable income?
Right. Right. So the tax bracket itself goes up to 321,000, but that doesn't matter because they don't make that much money, right?
Okay.
So again, the way that I like to think about it is I've got, think of having a big barrel full of all the money you made in the year and you're pouring the money out, right? Some of it gets poured into here, okay? And then I pour into this one till it's full. And the way to tell how much it can hold is I say, this is the last dollar it's allowed to hold, but this much has already been accounted for in the earlier one. Okay. For this very last one, we don't look at how much it can hold. We just look at how much we actually have left to dump into this bucket.
Oh, okay. Thank you.
Sure. All right. So now let's compute the tax. We have 10% of the 19,400. That's $1,940. We have the 12% of $59,550. So that's 7,146. Okay. 22% of 89,450. Okay. So we get 19,679. And then finally we get 24% of $825. And that comes out to 198. So our computed tax is 1,940 plus 7,146 plus 19,679 plus 198. And when I add those together, I get $28,963. Okay. So that's how much computed tax we have. Now we look at the credits. Okay. And we said in the problem that they might get a per child tax credit. Okay. They're definitely not going to get the earned income credit, right? If I look at their adjusted gross income, 212,000, right? Earned income credit maxes out long before that, right? You don't get anything if you suppress these numbers. So I think that, they're married, that they're way past the income threshold to be eligible for that credit. Okay, but they can still get the child tax credit, $2,000 per child. Okay. And we said they had 2 children, I think. 3 children. So we have $2,000 times 3 children. So we get a $6,000 credit. Okay. So their total tax liability is going to be the computed tax minus the credits. Okay, so we take the $28,963 and we subtract $6,000 and we get $22,963. Okay, and we have one more part to talk about. When you look at your paycheck, you get taxes taken out every single paycheck. Okay, so when you go to file your taxes, one of the things that you get at the end of the year, right? By the end of January, your employer is going to give you a W-2, and it tells you how much money you made during the year. It also tells you how much money you paid in taxes during the year. Okay, so in this case, it says that the Andersons paid a total of $24,850 in taxes during the year, right? Just taken out of their paychecks. Okay, so what we do is we say, okay, if I subtract the withholdings, okay, let's do this in a different color. So our tax was $22,963. We said our withholdings were $24,850. Okay, so I get a negative number here. Now they still paid a positive amount in taxes, right? This family paid $22,963 in taxes. That's what they owed for the year. But during the course of the year, they overpaid by a little bit, right? So we end up with negative $1,887. When I subtract the withholdings and get a negative number, that means that they are owed a refund. So a refund is not the government putting money into their pockets per se. I mean, they're going to get a check from the government, but what it is it's just giving them back some of the money that they paid because they overpaid. Okay, so they will get a tax refund of $1,887. So the government still made plenty of money off of them. The tax refund is just because they had too much money taken out of their paycheck, during the course of the year. All right. Any questions on that? I think it's a lot to take in, but we're gonna leave that here for today.